Welcome, ladies and gentlemen, to another edition of Accounting 101 made simple by J. Ham. Today's topics discuss lesson number 11. We will be preparing the balance sheet. So in the previous video lessons, we discussed the elements that made up the balance sheet. Now we will prepare the balance sheet based on the year-end general ledger balances in the following slide of a fictitious company that I made up. So this represents the general ledger. So at the very top, you always want to list what your report is. This is the general ledger, and you put it always put it to the left, the top left-hand corner of any type of report, and this is considered a report. So you want to list all of your accounts. So you have cash and cash equivalents, you have notes payable, treasury stock. I didn't put this in order of balance sheet classification, such as current and non-current, because I just wanted to enhance the exercise, the learning experience, basically, when we go and identify the balance sheet classifications for each of these general ledger accounts. So what I like to do rather is put a balance sheet classification column off to the left of the figures. And what this column serves as is going to identify, we're going to use that to identify all of our general ledger account. And like as current, or a current like asset, or current liability, or a long-term asset and a long-term liability, stockholders equity rather, tongue-tied, sorry, and things of that nature. So that's what we're going to do. So first thing we're going to do here is identify all of the current assets, because current assets is going to be the first section of the balance sheet. So we identify all of our current assets. We have cash and cash equivalents here. Let me get a pen going here so you can see what I'm talking about. So you have cash and cash equivalents is a current asset. Current asset. We have prepaid expenses. Remember we spoke about prepaid expenses. Supplies or any type of prepaid expenses paid in advance. And then as you use it, you diminish the value of it, or you amortize it. Then we have inventory, and then we have our accounts payable net. And what net means is it's net of allowance for doubtful accounts. As we briefly discussed in a previous video lesson, that allowance for a doubtful account, we didn't briefly discuss it. We went over it pretty much, like we went over it well. So allowance for doubtful accounts is the contra AR account. It's a contra asset account. So it gets netted against the accounts receivable account. So when you sell a product to a customer and you set up accounts receivable, you're waiting for the customer to pay you the money. Then a year goes by, he doesn't pay you. You call him, he dodges your phone calls. You don't get your money, so you set up an allowance for doubtful accounts. That's what that is. And like that account serves as, in the event of a customer not paying you or not paying you at all, that basically reduces the value of the AR account. So you always report accounts receivable net of allowance for doubtful accounts on a balance sheet. So that's important. And these are all of your current assets. This is the balance sheet, ladies and gentlemen. You have assets on the left side. You have liabilities and stockholders equity on the right side. And your total assets at the bottom of the left side, and your total liabilities and stockholders equity at the bottom on the right side. So basically we populated or transferred out from the general ledger account into the balance sheet all of the current assets for 2019 and 2020. So we have our cash and cash equivalents balance right here. We have $1 million for 2019. We have 1.4 million, for 2020. We have accounts receivable net right here for 375, and accounts receivable net for 525 2020. Then we have our inventory, and then we have our accounts payable. And for 200,000, and all of these numbers, remember, they're coming from your general ledger or your trial balance, your adjusted trial balance. But in this case, we're just focused on preparing the balance sheet, so we didn't get into the adjusted trial balance, but because we have to go over adjusting entries and closing entries, and in order for us to do that, we have to go over our debits and our credits, and that's an entirely different video lesson. So we have our total current assets for 2019 and our total current assets for 2020 right here. And then we have the 1.5 million, and then we have the 2.3 million or 2.4 million rounded up to the nearest 100,000. So then we're going to go back to our general ledger, and we're going to identify all of the non-current assets. We're going to identify these puppies right here. So what are our long-term assets? We identified two of them in the general ledger. Property, plant, and equipment net, same concept as accounts receivable net, but the contra asset account for property, plant, and equipment is called accumulated depreciation. We went over that in a previous video lesson. You always state property, plant, and equipment of a company at net, and when they say net, they mean net of accumulated depreciation. So if your property, plant, and equipment for the year is $100,000 and your accumulated depreciation is $900,000, you would report on this in the general ledger $900,000. That's how it works. So what's the next long-term asset that we identified? Land right here. So land, and we have long-term assets. This is going to help you out, because when you put your balance sheet together, you want to trace back all of the steps that you took to prepare that balance sheet. So this is a good way of doing it. You always want to be able to produce a final product, in this case the balance sheet, that someone can pick up and retrace what you did. So documentation is very important. So now we populate the balance sheet with our long-term assets. So we have property, plant, equipment here, net, and we have 4.8 million for 2019, 4.2 million for 2020. Same thing for land right here. And then we have 500 for land 2019, and it was unchanged, $500,000 for 2020. So now we can calculate what our total assets are, right? Because we have all of our current assets and we have all of our long-term assets. So the total assets for 2019 is $6,885,000. And then for 2020, the total assets, $7,057,000, right? And keep in mind, at the end of the day, these total assets have to equal the total liabilities here, right? Always keep that in mind, and when we finish populating the rest of the balance sheet, that's the objective. That's the first thing you got to look at. So now we go back to our general ledger account, and now that we identified all of our current assets and our current and our long-term assets rather, Now it's time to look at what our current liabilities are. So what's the first current liability we see in the general ledger here? Salaries payable. Remember, salaries payable is a current liability for wages of your employees earned, but you did not pay them yet, so you owe them that money. And this is a current liability. So we put that right here. What's the next one? What's the next current liability here? You see, if we go down prepaid expenses, we already identified that. Common stock, we know that's not a current liability, so it's notes payable current portion right here. That's a current liability as well. And then we move down. What's the next current liability? Mortgage payable, current. Now I put the current in parentheses to let everyone know that this is the current portion of the mortgage payable and the note payable. If you don't see the word current within parentheses associated with a notes payable or a mortgage payable, that means that it's a long-term liability. So always make that assumption when you're looking at it. So what's the next current liability that we see? Next one we see is income tax payable right here. And that's a current liability. Then we go down. What's the next one after that? Accounts payable, remember. And remember, we talked about accounts payable. What's an accounts payable? It's a liability where you know the exact amount of the liability. It's a current asset. It's a current liability. So what's the next current liability we see in the general ledger? Interest payable, right? That's a current liability. You take out a loan that we discussed earlier. They charge you a certain percentage. That percentage is basically the interest payments that you make to the company, to the lender for having that entity, him or her, loan you that money. So let's move on to the next current liability. What's the next one we see here? Next one and last one is accrued expenses. And remember what we talked about accrued expenses. They are an estimation of a liability. So you owe this person money, but you really don't know what it is because that person didn't give you a bill yet. But you think that the bill's going to be around $500, so you accrue for it until you get the bill, and then you true up that accrued expense to whatever the actual liability is, which is the amount stated on the invoice or bill. So that's current assets. So we're going to move all of these. That's current liabilities. Why do I keep saying that? It's current liabilities. So now that we identify all of our current liabilities, we're going to move it to the current liability portion of the balance sheet. So as you see, if you observe the right side of the balance sheet under current liabilities, we have our accounts payable right here. Get my little pen out here. We have the accounts payable. We have the accrued expenses, right here. We have the salaries payable. And we have the interest, here. We have the interest payable. We have the income tax payable as well. And then we populate the numbers from the general ledger for all of these line items, financial statement line items, right? This is considered financial statement line items right here, right? All of this is considered financial statement line items. Then you got your mortgage payable right here. So we have our income tax payable, the current liabilities, right? And then we have our current portion of the notes payable. And then we have current portion of the mortgage payable, right? Identify all of our long-term liabilities. So what are our long-term liabilities? First one we see is notes payable right here. We classify as long-term liabilities. See, we only got a few more to go, you see? We pretty much classified all of the accounts in the general ledger. What's the next long-term liability on the general ledger? Way at the bottom, the very last line item, mortgage payable, long-term liability. And then we're going to take these amounts right here for 2019. I'm sorry, for 2019 and 2020. And we're going to transfer them over to the long-term liability section of the balance sheet. So here's the long-term liability section of the balance sheet right here. These are your long-term liabilities, right here. So we have our notes payable. Whoops, sorry. We have our notes payable right here, right? And then we have our mortgage payable right here. And then we have the 1 million note payable 2019. And then we have 950,000 note payable for 2020. And then we have the mortgage payable for 2 million. And then for 2019, and we have the mortgage payable for 1.9 million 2020. So now we have our total liabilities. So our total liabilities for 2019, 4,105,000, and for 2020, 4,018,000. So now the last section that needs to be populated here is the stockholders' equity. So we're going to go back to our general ledger and we're going to identify all of those stockholder equity accounts. So there we have it. Everything is labeled once we identify the stockholders' equity account. So what's the first stockholders' equity account that we see in the general ledger? Treasury stock. Remember, we talked about treasury stock. Treasury stock is where the corporation buys back the stock from the shareholders it previously issued the shares. And it's a contra equity account, meaning that it reduces the value of your equity. What's the next stockholders' equity account that we see in the general ledger? The common stock right here. The common stock, shares issued and outstanding. And so that's stockholders' equity. Put that right there. And what's the next stockholders' equity account that we see in the general ledger? Additional paid-in capital, common stock, right here. Remember we talked about additional paid-in capital, common stock? What did we say it was? It was it's the amount that the investor or the stockholder is willing to pay over the stock's par value per share of stock. So remember, if a par value of a share of stock that's selling for $100 is $10, and you pay the seller of the stock $100, what's the excess of the par? The $90. That's what additional paid-in capital represents, right? We talked about that in the previous video lesson. So we identify additional paid-in capital, or APIC, common stock, as stockholders' equity. So what's the next stockholders' equity account that we see? Last one we see here is retained earnings, right here. And remember, we transfer those stockholder equity accounts to the stockholders' equity section of the balance sheet. So all of the stockholders' equity accounts that we identified in the general ledger, they're going to put under the stockholders' equity section, which is right here. So we have our common stock, right? We have a common stock of $1 million for 2019. Same for 2020. Then the next thing we have additional paid-in capital for $300,000, 2019, and $300,000 for 2020. And then we have our treasury stock and our retained earnings. All of this, remember, is getting fed from the general ledger. It usually gets fed from the adjusted trial balance, but we didn't cover adjusting and closing entries because that's an entirely different topic. We'll cover it in the future. So we have this treasury stock of 100 for 2019 and 125,000 in 2020. Whoops, sorry. And then we have our retained earnings right here for 1.3 million in 2019, and then we have it for 1.6 million in 2020. So we have our total stockholders equity account right here. Whoops, sorry, right here. And that's 2,780,000 for 2019 and 3,039,000 for 2020. So we populated the entire balance sheet. So the first thing we have to do when we finish populating our balance sheet is make sure that our total assets right here equals our total liabilities and owner's equity right here. Right? So does it equal? Do the total assets equal the total liabilities? So for total assets 2019, we have 6,885,000. And for 2019, we have total liabilities and owner's equity for the same amount. So it's equal, right? For 2019, we know that our total assets equal our total liabilities. So we move on to 2020 now. 2020 total assets, we have $7,057,000, and for total liabilities and total stockholders equity rather for 2020, it's the same amount right here, $7,057,000. So we know that for 2020, same as 2019, our total assets equal our total liabilities and stockholders' equity. So, one thing I want to note here, this is what you call a comparative balance sheet. This is usually the common presentation of balance sheet in the accounting industry, right? So, you're comparing two periods. We're comparing 2019 to 2020. The only way you won't see a balance sheet that is not comparative is if it's its first year. If it's its first year, you don't really have anything to compare it to. So, obviously. So the next thing I wanted to point out here is the very first number you see, very first figure that you see on the total asset side in a column, any type of column. When you're listing numbers, you always associate a dollar sign with the first number. So if you have a total of numbers, you always put the dollar sign at the very top, the very first number, and the very last number right here. If you go over here, you notice there's a dollar sign. That's what you do, and everything in between doesn't get a dollar sign. That's the common practice in the accounting industry. And then if you look at 2020, the first figure in the column, right? You got $1.4 million. That gets a dollar sign. And then the very bottom, the total, right, always gets the dollar sign. So the first figure and the last figure, they always get the dollar signs. So same if you go to the right side of the balance sheet. Look at it. You're talking about this whole column of numbers right here, right? You're talking about this whole column. What's the first number in the column, right? First figure rather in the column, $450,000, right? It gets a dollar sign. Same with 2020. it's a column as well. It's a list of numbers, right? Well, hold on. I'll keep on right clicking. I don't have a mouse. I'm sorry, ladies and gentlemen. Okay, so you go down. This is a list of numbers all the way down here, right? What's the very first number? It gets a dollar sign, $530,000. What's the very last number, or last figure? $7 million down here. It gets the dollar sign right here. So that's pretty much what the balance sheet is, you know. So you took a balance sheet from the general ledger and you were able to produce financial statements. Well, one portion of the one financial statement. You know, we're going to go over the income statement in the next video. But this is the balance sheet. Always keep in mind that it has to balance. Your balance sheet has to balance. That's why you call it a balance sheet, because it has to balance, meaning that the total assets have to always be equal to the total liabilities and stockholders' equity. And that's pretty much it. And also with presentation, you know, if you look under the current assets and you list all of the current assets right here, you notice that it's indented. So when you list current assets, you always want to put current assets and then put the colon sign right here, and then you want to indent the list the current assets below the title. So always indent it, and then you bring it back under current. You bring it back to total current rather right here. The indent. So you don't indent that. So you want that to be the same as your the current assets, right? So it lines up. You see how that's professional? You see how all of your current assets, they line up perfectly? And then you do the same thing with your property, plant, and equipment, your non-current assets, and your land, right? You see how it's indented? You see how non-current assets right here, it's listed, it has the colon, and then it's indented, so it lines up perfectly, right? And the same thing on this side. You have your current liabilities here. First, you put your title, right? So that's what you do. And then you go over to the right side of the balance sheet, your accounts payable. You have your current liabilities here, right? You have your liabilities and owner's equity. That's the title. And then you keep and then below that you have what makes up the liabilities, and the stockholders' equity will start with the current liabilities. So you have the current liabilities, and we're indenting all of the current liabilities. You see how they line up perfectly? Those are all your current liabilities right there. Same thing with long-term liabilities. You got the colon sign right after long-term liabilities, and then you indent all of the long-term liabilities, which is these two line items right here, the notes payable and the mortgage payable. And then you have the total liabilities. You could indent it or just keep it. You always want to make sure that it lines up, you know, properly. And then the same thing with stockholders' equity. You see how all of the stockholder equity accounts or financial statement line items are indented and they line up perfectly. So that's pretty much the balance sheet, ladies and gentlemen. In the next video lesson, lesson number 12, we will be covering the following topic: the income statement part 1, revenue and cost of sales. Ladies and gentlemen, if you like my work, please hit the like button on this video. Please subscribe to this channel. Please share this video on all of your social media. And please be sure to sign up to become a Patreon member to enjoy exclusive benefits. May God bless you, and see you in the next video.